Well, welcome to today's edition. They're looking through cash flow. Cash flow statement.
Record.
You said? Good. Welcome you all once again to cash flow. Cash flow statement or statement of cash flow. Now we'll quickly run through what we did last week. Yes, what we did last week. Where is this thing? Good. I think Good. We said that cash flow is just the movement between cash in and then out of the organization. Movement of cash in and out of the organization. That's the cash flow. Basically, it explains why profit is not equal to cash. Good. So that is it. Or we prepare to do what? To reconcile the difference between profit and cash. Profit is not equal to cash because of three items. Basically, they are: one, non-cash item. Non-cash item. Two, or non-cash transactions. Two, accruals, because we use the accrual basis. Three, capital expenditure. And what? Public loans. This will always cause the difference between your profit and then your cash balance. So once they are not the same, then you can probably prepare a statement to reconcile the difference, and that's it. And we said that for cash flow perspective, the organization's activity has been grouped into three. Yes, three. One, cash flow from operating activities. So operating what? Activities. Two, investing activity. Then three, financing. Good. That's all. So much. Putting it, this is a cash flow, cash movement for the year. Good. So now what we do is this. You should know what goes under operating activity, what goes under investing and then financing, that's all. Operating activity basically talks about the cash flow from your core trading, your direct trading. That's the operating activity. Good. So it includes what? Cash flow from customers, cash received from customers, cash paid to suppliers, expenses paid, tax paid, interest paid. All these are the operating activity. Just that the interest, if your principal activity does not deal with interest-related transactions, then you cannot bring another operating activity. Good. We went to investing activity. Because investing talks about your non-current asset, that's all. Your non-current asset, that's the investing. This one talks about your operating activity, probably your profits, cash from profits. I hope you get it. Good. So that is it. Now let's probably move on. Okay. Now the issue is that when you go to financing, it talks about equity and then non-current liability, equity and debt. Equity and what? Non-current liability. That's what the financing talks about. Just that there are two methods in which you can use to prepare the cash flow from operating activity. But the financing and investing, they don't have any method. They have one way of preparing them. So you have the direct method and then the indirect method of preparing cash flow from where? Operating activity. So if you want to prepare cash flow for operating activity, there are two types or two methods, direct and what? Indirect method. With the direct method, that one use direct cash flow. It is what? Direct cash flow. So that one, we don't include any profits. So direct method. The cash flow from where? For operating activity. So first of all, cash received from customers. Cash from customers, you add less what? Cash paid to suppliers, less expenses. So cash received from customers, so much. Cash paid, expenses paid. That is it. Then you get your cash flow from operating activity before interest and tax, or cash generated from operations before interest and tax. Then the interest paid, and then the tax paid. So much, and then we are done. I mean that is so easy, straightforward with a direct approach. So take note for me, so straightforward, then you'll be fine. So that is it. Now the indirect approach, that's the stubborn guy. Yes. For the indirect approach, as the name suggests, indirect. So that one, we use profit. We pick the profit, the accounting profit, one of the accounting profit that you do, you're aware of it. When you are doing the profit and loss statement, it's inside one of the profits. You pick it and massage it to get what? To get cash flow, to get cash. Which of the profit are you going to pick to massage? We pick the profit before interest and tax. But before that, we pick the profit before tax. So much. Add back your finance cost in a P&L. So much. What do you get? You get what you call profit before interest and tax. It means that you can pick the profit before interest and tax straight for it, but don't do that. Go through this approach. Take your profit before tax. You massage it. And you're going to massage this guy with the help of 3 items, because we said 3 items affect profit and cash. So we are going to massage it with what? 3 items. 1, non-cash item. 2, accrual. 3, alien. They say adjustment. Adjustment for all non-cash items. Examples of non-cash items, they are depreciation, impairment, amortization, inventory written down. All of that should come. Now check the effects. If they've added to this profit, you are reversing it. You reverse it by what? Subtracting. If they have subtracted, what do? You reverse it by add back. That is it. Then you can also do that by profit or loss on disposal. Profit or loss on disposal. Here, you are reversing it because 1, it's not an operating activity. When you sell any of your PPE, you don't need to bring it here. When you sell investment, it's not yet. It's supposed to go to investment activity. So reverse it. If it is a profit, they have what? Added. So what do? We have to subtract. Now, if it is a profit, they have added. So what do? Reverse it. If it's a loss, they've subtracted. What do? We add back. That is it. Then changes in working capital. So do those workings for it. That's the inventory, receivable, and then the payable, the movement in it. Check the first video to get a bit of it. So the changes, you add all the changes to here, there, sum them up, bring them here. Now, putting all this together, that's the operating cash flow before interest and tax. Operating cash flow before interest and tax. So if this is the operating cash flow before interest and tax, then interest paid as usual, tax paid as usual, then we are done. So this is a bit intro. Can we get a first video to watch to get the full version? But the first video contains the full version of all this. This is a recap of it. Good. Now that we are done with the format, there are 2 examples in a handout. Those examples are yours. Those examples, they are yours. You try those examples for me. Today, I'm going straight to solve one of your past questions. So we are going straight to solve one of your past questions as illustration. I'll take time and go through those. No, I'll do that. Before I solve the past question, I have to solve some easy, simple one before the past question. Well, you know my style already, right? We start with a very difficult one and coming down slowly. So I think we can still start with that one. Where's the question? So you can open to your handout if you have yours there. The cash flow. You can open that one if you have your own there. I'm opening mine. Good. I have mine here. If you don't have, go to the page. Check the last post that I did before I left. My last post was, I sent 2 notes. One was cash budget, one was cash flow. But after the cash flow, we are doing cash budget. So that's the note that I sent. Means that now I knew that something terrible may happen to the phone. That's why I push it through the platform before leaving. Good. Okay, so that is it. Now, example 2, example 1, as usual, they are yours. So try them for me, these examples. Teacher, I'll take your solution. When it's ready, let me know. You try this example using the direct approach. I think it's in the previous video too. And then you try the second example using what? The indirect approach. Now, when you are done, and I'm going to the cash flow itself. So you should know all the items that will affect them. So for cash flow from operating activities, we have to look at it. Now, when you go to cash flow from investing, the investing activity, with the operating activity, all what you need is the indirect method approach, the formats, the direct method, the formats, and then you are done. The items that goes in there. With the cash flow from investing, that one is about non-current assets, purely non-current assets. Go and check the non-current asset, the movement. Are they buying new assets during the year, or they are selling their assets? Are they investing? Is there any investment income? So the list are 1, acquisition, and then purchases. Sorry, acquisition and disposal of what? Non-current assets. That's PPE. Acquisition and disposal of what? PPE. 2. Acquisition and disposal of what? Investment. 3. Interest received or dividend received. In fact, go to the investment income. Any of the investment income that they have received, it is what? You take it off from the operating activity and send it to where? Send it to investment. Why? Because the other income, they are not operating activity. They are what? Investing activity. Meanwhile, in the profit and loss statement, we don't have operating activity. We don't have financing activity on the profit and loss. That's one of the issues that normally create confusion. In the profit and loss, everything goes. Everything, all profit, all revenue, you just add them, then you go. But cash flow is not like that. No. The cash flow should be grouped into 3. Some of them are operating, core. Some of them are investing. Some of them too are financing. So you have to group them accordingly. But because we are picking the profit, this profit contains the other income. Meanwhile, most of the other income are financing, especially those that have the cash flow. So they are not investing. So you send it to investing. Good. So let me go over again. Investing activity items are acquisition or disposal of PPE or non-current assets. Acquisition or disposal of investment, like long-term investment. And then investment income received, dividend received, interest received, in fact, anything received, that is it. Good. Okay, so let's probably move on. Now let's go and solve our first question. our very first question. First question, we will solve example 4. Before I come to the past question, I'll use the indirect approach for example 4. For example 4. Then on tomorrow, we'll do example 5. Example 5 is your past question. I wish I can do that one first. So when I start with the past question, may see stars. Have you seen the cash flow? The note are not menu. The note are up to what? Note 4. Unlike the P&L where the note are how many? The notes were 10. So take notes. So let's do example 4, okay? So that our next one, by then, we'll be conversant with the terms and then how to treat these items so that we can go straight and then kill the past question. Kill the example 5. Example 5 is a past question, Addom Limited. So we are doing the example 4. So let's see the example 4. Example 4 is what? IE. Pearl. This is Pearl. This example is Pearl. The following information is available for Pearl Limited Liability Company. A is not there. In fact, it's supposed to be A Limited though. Make it Pearl Limited. But the A should be deleted from there. Now let's go to the requirement first and be sure that it's a cash flow to avoid waste of time or allergy. Now, prepare the company statement of cash flow for the year ended 31st March 2005 using the indirect method, adopting the format in IAS 7, statement of cash flow. Statement of what? Cash flow. Let me do this. So, when we solve the example 5, probably tomorrow, I'll explain why this stating the indirect approach is more likely than the direct approach. Good, now let's move on. Now we are preparing cash flow. I choose that the right approach. Read the requirement first, go to the additional information. Now in cash flow, they'll give you 2 years. Yes, let me explain this. Especially for the financial position, it's compulsory, mandatory for the examiner to give you 2 financial statements, financial position. But for the profit and loss, no, it's only for the current year. So take notes. Good. So for the cash flow, they will give you 2 solid years. Current year and the previous year. Current year and what? The previous year. Now with the current, you have to give out 2 financial statements, or if possible 3. But the 2 is okay. They have to give you the income statement and the financial position. So the financial position, they'll give you the financial position. Prepared for 2 years, current year and previous year. This is how they're supposed to arrange it, but it doesn't matter. They can decide to bring the previous year here, current year to here. Doesn't matter at all. What matters is you can see years over there. Then the income statement, that's the profit or loss. They have to also give us the profit or loss. But that one, it's only, we only need the current year. So profit or loss, only current, no previous. If they put the previous year, we don't probably need much information from there. We don't need it. So take note for me when they put the previous there. So this is the information. But you're going to prepare for the current. So when you see 2 financial statements, don't worry, especially for the financial position, and then you'll be fine. So take note for me. So we are going to start the cash flow. We are using the indirect method. We are using what? Indirect method. Tomorrow's question will be using direct method. Tomorrow's question will be using direct method, and then you'll be fine. Good. Now, we will start. by saying there are three protocols. Hey, you've not gone through the note. Let's go to the note and see. The three protocols. Let's go to the note. Now go to the note. Note 1 says that during the year, non-current assets which cost 800,000 with a current value of 350,000 were sold for 500,000. Wow. So first, two items here. It will affect operating activity. Why? Because the profit has been added. So quickly you find a profit on the sale of the non-current assets. And like I said, whatever we did under the profit or loss is still examinable here. It's still examinable here. So take note. Now, you have to calculate the profit or loss on disposal by subtracting the current amount from the proceeds. Good. Then we look at the treatment. Have they added to the profit? If it's a profit, they've added. And then we have to reverse it by subtracting it. Why are you reversing it? Because when you sell non-current assets, when you sell PPE, it is not an operating activity. But the profit has been recorded in the profit. So that's why we are reversing it. Then, if it's not operating activity, after we reverse it, where do we take it to? You have to take it to what? Investing activity. But don't forget that when you go to investing, you have to record only the cash element. Only the cash element, the 500,000, not the profits. Good. You reverse profits and record cash. So take notes. Then let's move on. So that note is cleared from the way. And note 2 says that the capital surplus increase. No, take it in. The capital surplus increase from the revaluation of the land. They are telling you the source of the increase in capital surplus. They say the capital surplus increase is as a result of what? Valuation of some land that was not being depreciated. So you check the movement in capital surplus. It's as a result of the revaluation. We will confirm that note when we start the actual calculation. Good. So that is it. Okay, now let's. So 3 says that in 2004, income tax liability was settled at the amount provided for in 31st December 2004. Okay, this note. Well, this note we don't need it. Yes. But why is it there? Just the calculation will confirm it. Yes, the calculation will confirm it. So that note, there's no figure there, so not much important. Now let's go to note 4. Additional loan notes were issued on January 2005. Interest was paid on 31st June and then 31st December. Good. So it means that the movement in the loan notes, if they have increased, if the loan note has increased, it means that they've issued new one on January. So the increase in the loan note, we can contribute it, or we can tell the company that the increase in the loan note is as a result of what? The new issue on what? January. Now the date was given to you for you to calculate the interest well. So take note. Dividend paid during the year amounting to 750,000. Dividend is a financing activity. For financing activity, when you get the first one, it will spell all of them for you. Now, but we can still go to financing activity. It talks about your equity, and then the long-term liability. That's a financing activity, your equity. So if you want to get the financing activities, your equity section, check the movement there, and then the long-term liability. Yes. If you issue shares for cash, it's a financing activity. If you go for new loan, it's a financing activity. If you pay part of your loan, it's a financing activity. Just that when money is moving out, you subtract. When money is coming in, you add. That's it. Then what do you do again? For financing, any transaction costs on issue of shares, transaction cost on loan, and issue costs, all of them are financing, plus dividend. Dividends are under financing, except for if you have registered your business. To be dealing with dividend-related transaction, that one dividend becomes operating activity. And then sometimes interest paid can also be under financing. Why? Because if you have not registered your business to be dealing with interest-related transaction, then interest that you've paid is not an operating activity. It's what? Financing. Thank you. So that is it. Now let's go back to the question, and then you'll be fine. You will be fine. Now we are done with the notes. Dividend is 750 to go to financing. Then we are done. Now let's scan through the financial statement. Rough. You scan through. Is there any usual and unusual? These are first time. So for first time there, everything will be what? Unusual. Yes, for first time, everything will be unusual. Even we stop 2 examples. So there should be repetition. Just that it wasn't a full question like this. So you can see 2005 current year. This is the closing balances. Now this is the previous year. This is the open balances. So take note. If you want any open balance, you come and pick for 2004 open balance. If you want the closing balance, 2005. Current year, previous year. Current year, previous year. Current year, previous year. You are done. Now the examiner can also change the pattern. He can place the previous year here and the current year to here. Doesn't matter. What matters is the dates. 2004 and 2005. You can't tell me that 2004 is current than 2005. No. So take note. Now it's scan through the item. Let's scan through. Starting from the non-current assets down up to equity and liability. Now, non-current liability, you can see. Sorry, non-current assets. You can see cost or valuation. It's not OE, it's cost or valuation. So if you have the hard copy, you can change it. Cost or valuation. Then accumulated depreciation. Have you seen the accumulated depreciation? They've subtracted it. So this is the current value or current amount. Good. They are there. So you just check the movement. It has increased. Upon selling, it has increased, meaning they have purchased some. So you are going and calculate it. So you go and calculate it. Look at how we are going to do that calculation. Then you'll be fine. Then you go to the current assets. We have inventory, receivable, cash at bank. Inventories and receivable, we are going to compare the movement. We are going to check the movement, and that will form the changes in working capital. So inventory, receivable, and payable. Cash, we will do the balancing. Cash, we will balance it, and then we have the 10,000, and then the 13,000 too. Now when you go to equity, stated capital is 1,000. It has not moved, right? So no movement. Stated capitals are moved, no movement. So no issue of what? Ordinary share during the year. Capital surplus, this one is revaluation. And the capital surplus, the movement is what? 1,000 and 1,005. So the movement is what? 500. And we're saying that the movement is as a result of what? Land. So that's good news. Now income surplus, we won't take it except for if they have not given a dividend, then we confirm. Because we already have the profit. They have given us the profit or the summary of the comprehensive income. So hopefully we can get the profits over there. Now let's move on. Non-current liabilities, 10% loan note. It has moved from 2,000 to 3,000. Wow. So they have what? Issued in loan note of what? 1,000. And that 1,000 is a finance activity. So you go to financing, 1,000. Well done. That's all. Current liabilities, trade payables. As usual, you match it under the change in working capital. Income tax, that's the tax paid. You do separate workings for it, then you are done. So this one is an illustration. Now, summary of the comprehensive income for the year ended 31st March 2005. Have you seen that here they didn't give us a double year? No, just the current year we need. Even if they give you for the 2 years, please don't pick the previous year's items. Don't do what? Do not pick the previous year's item. Do not pick the previous year's for the income statement, except for striking balances. So profit from operation, finance cost, loan notes, interest, income tax expense, net profit. Good. So we are done. Now we are going to the board to set a tone for it. Look at how you're going to solve it. And this is how we want it in exams. So the three protocols, as usual. The three protocols. Don't forget the three protocols. One, the name of the company. So here was the name of the company. Hell Limited. Hell Limited. Hell Limited. Then statement of what? Statement of cash flow for the year. Please, if you're supposed to write the exams, Tuesday is the day that you're going to write the exams. So don't forget that Tuesday, I'm having my exams. I'm writing a mock or a test on Tuesday. Yes, no areas. From Gangan to Kanka, whatever you've done, it's coming Tuesday, live and colored, because you're going to write your paper on Tuesday. If there's not been the outbreak, by now you're on hot seat. Yes. So statement of cash flow for the year. All financial statements are what? Headed for the year ended except the financial position. So for the year ended 31st December 2005. I'm done. For cash flow, you can use one. You can just use one currency or the two. Yes. So let's see, Ghana cedi here and Ghana cedi 2 here. I'm using the two. I hope it is visible. The board is visible. If it's not visible, please let me know.
It's like I'm not seeing well. I don't know whether it's my network.
It's not visible.
No.
If I don't forget today's history will blow your mind. No, after the end of each class, there's history for the day. Yeah. Today's history will be super fantastic. Okay. So you start cash flow from where? Operating activities. So you write cash flow from operating activities. Then you are probably done. So cash flow from where? OA, please, no shortcut in exams. Operating activities. Cash flow from operating activities, no shortcuts. Cash flow from operating activity, no shortcut. No shortcut. Good. So that's the cash flow from where? Operating activity. Then you start. I hope it's better.
Yeah.
Good. So that is it. Sorry, I've where's the case. Sorry, I've where's the case. Okay. Good. Then this one's okay. Now, cash flow from operating activities. We are using the indirect approach. With the indirect approach, where do you start from? You start from profit before tax. So you write it first before going for the item. Profit what? Before tax. So let's go to the question and look for the profit before tax for me. Your profit before tax. Let me push it upwards. Oh, yes. Profit before tax. So from the question, now be with me. Let's go and pick the item together. For the first one, we are doing it together. Oh, yes. So this is the income statement. And now, I believe you are keen in preparing financial statement, the profit and loss. So now, with this profit and loss, who can tell me the profit before tax? And then that person will be what? The accounting cracker for the day, profit before tax. So kindly select it for me. This is a summarized comprehensive income. The profit and loss that we've been preparing. What's the profit
2350.
before tax? Good.
2350.
So profit before tax. If you get it, type it. Yes, I have. So I'll expect everybody's answer. Everybody's
Okay.
answer. Everybody should get it for me. Oh, yes. I'm waiting. Yes, someone else. Yes. Okay. And you know the rule, right? I like that.
Okay, profit from
Yes,
operation
Madam
expenses.
Elon. Okay, I like that. Good. Please, waiting. Yes. Waiting. Kindly get a figure for me. How have you done it? Is there? Oh, that we've not named it. Good, 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 good. But everyone got right. That's perfect. Now let's move on. In fact, the profit. Oh yes, yes, yes. In fact, everybody. Hey, why? Everybody. But everybody. Okay. In fact, how do you get a profit before tax?
Fred, you told us that the thing is there and it hasn't been labeled. So what do you think we'll go for? That's it. But that's it. He says it's there. It hasn't been
You know
named.
what, from
So
operating,
if you look into
from operating whatever profit, you go to profit before interest and what is it? Income tax. So me, when I saw the finance cost, I said the first one will be the profit before
Okay,
tax.
so the one before the tax is profit before tax, eh?
yes,
Good.
that's how I was.
Yes, but that's how we will probably pick it. Good, 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 good. Good. Now, check this for me. Now check this. Facts. That's. But the question is, we didn't name it though. It's part of the game. Oh, we didn't name it. It's empty. Yes, that's the figure. Correct. It's empty. So this profit from operations, that's the profit before interest and tax, less finance cost, 300. So you get profit before tax, less income tax, profit after tax. So that is it. Good. So that is, so the profit before tax will be 2350. Then you pick it nicely. So 2350. Good. Then we continue. You add back the finance cost, the interest expense, interest. That's the finance cost. Interest. Expense. What's the interest expense? The interest expense. Add back the interest expense. So you can tell me the finance cost. It was 300,000, right? Yes. Check from the question if they've raised 3 zeros so that we will raise the 3 zeros for them. Yes, they've raised 3 zeros. Finance charge is what? 300. So we have to also do the same. Good. Now, we have to raise the 3 zeros. So let me find a way of raising it here. Don't forget to do the same. Now, when you add, what you get? So 2650. Basically, this is the profit before interest and tax. So we call it profit before interest and tax. How we get that? Good. Please, this is in the question already. Don't go and pick it too. Because if you pick it, you will start from here. You lose 1, 2 ticks. You will start from here going. Yes. Because that's yes what? The standard. Because IAS 7, that's the statement of cash flow. IAS 7 stated that the cash flow from operating activity should be started from the profit before interest and tax using the indirect approach. So take notes. So now let's move on. Now that we get the profit before interest and tax, what do we do next? Adjustment. So you say adjustment. Adjustment for, wow, we are going to adjust for 3 basic items. 3, there are 3 in number. 1, is there any transaction or item which is non-cash, which has entered this profit? Oh yeah, let's reverse it. Non-cash item, such as depreciation. Have they charged depreciation to this? Is there any item which they've not paid cash but has entered this profit? What do? Let's reverse it. That's 1. 2, accruals and prepayment. Accruals, the expenses that they are owing, they've not paid for, but it has entered the profit. They've subtracted it. What do? Let's go there and then reverse it. So 3, alien. Alien, transaction that they don't form part of what? They don't belong to operating activity. Oh yes, because according to cash flow, the organization activity should be grouped into 3. Operating activity and what? Operating activity and investing, finally financing. So some of the items that they have recorded or recognized, they don't have what? They don't belong to operating activity. For instance, the alien or the other income. The other income, they are alien. So check. Examples are profit or loss on disposal. Profit or loss on disposal. When you sell your PPE, please, it is not an operating activity because it didn't register your business to be buying and selling PPE. So take note. So anytime you dispose of PPE, it must go to where? Investing. Good news. Now, meanwhile, in the profit and loss statement, there's no demarcation for profit from operations, profit from investing, and profit from financing. No, because anything goes, we put all together. So all of them have been grouped here. So that's why we are going to do the separation. So profits, so you are going to adjust for 3 items: non-cash item, accruals, other income, or alien item. Any item at all which has entered this profit, but it's not an operating activity, reverse it and send it to where it's supposed to, where it belongs. So other income, that one belongs to what? Belongs to investing activity. Just that when you go there, you record cash flow. Good. So assume that you have an asset, like this question. The asset, you sold it for 100 Ghana. That's the proceed. The current amount is 80 Ghana cedis. So that means you have recorded a profit of 20. This 20 is inside this. So I come and reverse it. Why? Because this 20, which is profit, it is not an operating activity item. So I have to send it to investing. Just that when I go to investing, I will not pick this 20 because it's not a cash flow. I'll pick the one that is the cash flow. That's the proceed, the actual amount that I receive. So I'll use this question to do the illustration for you. So now let's go to the question. You check from the P&L and check from the footnote. Is there any item in the P&L and the footnote that suggests any of these 3 items? So let's go. Non-cash. Always don't forget about depreciation. So depreciation. Depreciation. Sometimes if you are lucky, they'll give it to you. If you're not lucky, don't give it to you. So that is it. If they don't give it to you, you go through the process then to get it. So let's go to the question and see. Good. So no, depreciation. No, depreciation has not been given. So you have to do the workings. So let's go and do the workings. So first workings number 1, depreciation. But the first one is there, we can do that one though. During the year, non-current asset which had a cost of 800,000 with a current amount of what? 350, were sold for 500,000. So now let's see what we will do. Good. Now we are going to calculate for probably the depreciation. Let's go and work for the depreciation first. Yes. Now let's see how you are going to get a depreciation if they don't give it to you. If the depreciation is not given, look at how you will do probably to get it. When depreciation is not given, how? One, you come here, then you say workings. Now flow with me, workings. Workings. Now, we are going to do this. When you are doing the disposal of PP, when we dispose of PP, we reach some place and we say that do the thing. That's the do the remover. The remover. That remover. That's what I'm going to do here. So if you can probably recast your mind back to what we did under the disposal, the last entry. Anytime you sell an asset, take the details of the asset, the remaining balance before you send it there. So that's the same thing you are going to picture here. So here we are going to use workings one, the depreciation. Yes, that we are going to pick it from accumulated depreciation. So pick it from accumulated depreciation. The open balance. What's the open balance? You know where to get the open balance from, right? Where do you get the open balance from? Where are you going to get the open balance from? The open balance will be from the previous year. If you get, you can type it for me. Now let's go. Open balance of the accumulated depreciation is on the financial position. The open balance is on the financial position. Good. Accumulated depreciation. Open balance is what? 4,800. So I'll put a 4,800 here. Good. Once you get the open balance, ask yourself this question. Did they dispose of asset during the year? Is there any disposal of asset during the year? Oh yes, there was a disposal. If there was a disposal, bring it. Disposal. What is the accumulated depreciation of the disposed asset? So disposal. The accumulated depreciation of the disposed asset. Good. Is there any other item that will affect the accumulated depreciation? Good. If that's all, then charge for the year. That's the balancing figure. Charge for the year. That's the depreciation charge for the year. That's what we are looking for. And that's the balancing figure. Then you come here and make the closing balance here. Closing balance. And the closing balance is it's in the financial statement, which is what? Good. So the closing balance is 5,600, right? So let's see if it's true. Please, if you have any question, kindly ask. Either you type or you raise up your hand. Now the closing balance 5,600. Now let's go and pick the accumulated depreciation of the disposed assets. Now, according to note 1, during the year, non-current asset which had a cost of 800,000, the cost is 800. Good. So cost of 800,000 with a carrying amount of what? 150. Oh wow. So what will be the accumulated depreciation? Who can tell me? Now what you? Now the cost of the asset is what? 800. But the current amount is 150. How do you get a current amount? See, come again. That accountant. Current amount is equal to cost less what? The accumulated depreciation. Now this is what you are looking for. We know the cost to be 800, right? We know the cost to be 800. Good. We know the current amount to be 152. So 150 is equal to 800 less what something, less the x, we don't know, right? So what should we subtract from 800 so that we can get 150? What's the answer? That's the accumulated depreciation. So that is it. So what should we subtract here? That's 800 minus 150. That will give us 750. So that will be 650, right? Good. You can probably do the entry. Someone to do the calculation for me. So it will be 750. So therefore, the accumulated depreciation is 750. Now when you come here, that's the accumulated depreciation. Sorry, 650. Okay, so thank you. So when you come to disposal section here, that's the accumulated depreciation of the disposed asset. Into bracket, 800 less what? Less 150. So please, whatever you've done, that's why the P&L, I took my time. And then like going too slowly. Here is a repetition. So we do 1 or 2, we move on, 1 or 2, move on in that case. So please, if the profit or loss and the financial position is still hunting, please, the videos are available. Kindly go and then probably watch them over and over and over again. You'll be fine. If not, can draw my attention. Okay. So here's 650. Is there any other item that will affect accumulated depreciation? No, don't affect it. So let's balance it. Now, we are adding. For disposal, that one you subtract. So don't forget. Plus the charge for the year, that's the depreciation charge for the year. So the question is this: what should it be there? That's the X. Open balance 4,800. When you subtract 60 from it, what should you add to this so that you can get 5,600? You can tell me the answer. So that is it. Have you seen it? So kindly get the answer for me. So it will be the 5,800. Any answer for me? I like that. 1450. Good. 1450. Confirm. Yes, I like that. Make sure that you get the same figure. 1450. So that's the depreciation charge for the year. That's the depreciation charge. So have you seen how we get it? If it's not given, it is not a big deal. Don't worry yourself. It is not what big deal. No, not at all. Don't worry yourself. It is not a big deal. This is one of the words, the straightforward questions or topics. So take notes for me. Good. Now depreciation, that's our workings one. So tell the examiner where you got it from. Now let's come here back. Good. Hey, that thing said to move. I think said to not move. Okay, I think it's okay now. Now, so workings one is 1450. So the question is depreciation. Are we going to add 1450 or we will subtract 1450? Are we adding or we are subtracting? Oh, tell me. Yes. Are we adding the depreciation to that of the profit? We are adjusting it. Don't forget all the adjustments. If they've added, subtract. Here you have to reverse it. So depreciation, they have subtracted. What do? We add back. Why are we adding back? Why are we adding back? So depreciation, they have subtracted. First of all, for the adjustment, we are reversing it too. Whatever they have done, we are doing the entry. Okay, there's a hand here. Jocelyn, I have a question. Jocelyn, you can unmute yourself and then ask the question. I'm here. Or if you can't do that, you can probably type it for us. Hey, okay, I think.
It's kind of difficult to unmute myself. Please, I got lost at the point. The 1450.
Yes.
How did we get it?
Yeah, the 1450. Okay, now get it for me.
Yes,
get it for me. The issue is this. But first of all, you understand.
So is it 4800?
It's a balancing figure. The missing one. Assuming that you have 4,500 there. Somebody, you took 650 from it. At the end of the day, you still have 5,600. I say, wow. So somebody gave you money. What's the money? That's the balancing figure. So the missing one. Here is the what? The balancing figure. Let me put B here. Meaning balancing what? Figure. Good. So add these two together. Whatever answer you get, match it. Come and face what? The closing balance. How do you get it?
Little.
Okay, so what do you get when you do it?
When I added the two,
Okay, add a two.
I had 5450.
If you do this, no, I disagree. 4,800 minus 650 is negatives in bracket though.
You said I should add. That's why 4,800 minus 650. I had 4150.
4150. Then you compare to this.
Yes.
What should you add to this before you can get this? What should you add to this figure before you can get this? So that's the difference, right?
Okay.
So find
Okay.
it.
Yes. Get it. Minus 4150. Okay, 1450.
1450. So from henceforth, anytime I'm looking for balancing figure, I'll come to you. That's how you find it. Okay.
Okay. Well noted. Thank you.
Welcome. If you have any question, you can probably chip it in today. I think the network is doing as good. Don't forget to get a history for the day. Okay, so let's move on. So I was explaining when to add and then when to what? Subtract. For depreciation, for the adjustments. Adjustment means we are reversing whatever they've done. Oh yeah, that's the meaning. We are going to reverse it. We are going to do what? Reverse it. Good. So ask yourself, depreciation, have they added it to this profit or they've subtracted it? Okay, depreciation, they've subtracted it. No, they should not doing that. So what do? Add back. It's because they have subtracted. That's why we are adding back. Positive. If they have subtracted, what do? We add back. But if they have done what? They have what? Added. What do? We subtract. So that's it. Okay. Now let's move on. Good. Then you check. Is there any profit or loss on disposal? Did they dispose any of their assets during the year? Is there any disposal? So let's go to the notes. Oh yes, there was a disposal. Let me even bring the details here for you. Yes, I remember the details. Let me bring the details here. Sorry. The cost of the disposed asset is 800. Current amount is what? 150. I want to cause confusion here. Proceed. Proceed is what? They sold it for 300. Or not that. How much? They sold it for 500. Yes. Now what do? Calculate the profit or loss on disposal for me. Just when your hand is still up. Do you still have question? Unless you tap it back again. Okay. Now, calculate the profit or loss on disposal for me and tell me whether it's profit or loss. Hey, there's another question again. There's another question. Good. And then Lillian, you have a question, ask.
All right, so Fred, please, you were saying that we should okay, how would you know whether depreciation has been added or not?
This one should come from the P&L preparation, the financial statement, when we're doing the profit or loss. So depreciation, have they added to the profit or they've subtracted? That's it. Depreciation expense, so they've what? Subtracted. What do? You reverse it. So that is it. It's coming from the profit and loss principle. So the whatever we did under the profit and loss is still valid here. Is that assumption that we are going to massage and adjust to get our what? Profit? Oh yes, because whatever they've done, that's the same way we have to what? Reverse it. How we get it?
Yes.
So check the
So
effect
here,
on profit.
okay, okay. So here, because the depreciation expense was added, of course, in the adjustments, we have to subtract.
Depreciation has not been added to profit though. Depreciation has not been added to profit. If you say it has been added to operating expenses, fine, I'll agree. But here we're looking at effect on profit. They've what? Subtracted it. Because depreciation, you add it to operating expenses and finally subtract. So the clue is that all expenses they've subtracted, all other income they have added, all what again? All expenses they've subtracted, all other income they've what? Added. How we get it? Good.
Yeah.
All losses they've subtracted, all gains they've added, all expenses they've subtracted, all revenue they've added. So now that you know that they have wrongly added, what do? They are going to reverse it. You reverse it by doing the opposite. If they've added, you have to do what? Subtract. So now there's something not that has been added. No. It's just testing your understanding in the preparation of financial statement, the profit and loss. So if there's a profit, have they added or they've subtracted? Good. So that is it. I hope you are fine.
So, yeah, that's why I'm asking that. So like, yes, I'm fine with the explanation. So that's why I'm asking that. For here, how would you know whether they added, or like how would you know whether they've added or they didn't add?
Good. It depends on that item. It's an expense. You have to know that from the profit and loss preparation that we prepare, do you add expense to profit or you subtract expense from profit? Good. You subtract. So they have subtracted. That is it. It's from the profit and loss. It's from the accounting principle, the accounting concept, the basics. How to prepare financial statement. How we get that? So it means that we have to familiar ourselves with the preparation and presentation of financial statement, especially the profit or loss, how we prepare it, how to treat certain transactions so that when they treat it, we can reverse it. So here it should be from where? From the profit and loss. Yes. And that's why we prepare the profit and loss first before doing the cash flow, so that you understand how we treat the items over there. So expenses, we have subtracted from the profit. That is it. Once it's an expense, you have subtracted automatic. You've subtracted it. Whether stated or not, they've subtracted it. Once it's an expense. Once it's a gain or revenue, they've added to the profit. How we get it?
Yeah, I do.
How we get it?
Yes, yes.
So that is it. Okay, so now let's probably move on. So now calculate the profit or loss on disposal for me, and let's see the figure. The profit disposal. So profit or loss on disposal, as usual, we sell two items. The proceeds less what the carrying amount, right? The proceeds is what? It's 500. They sold it for 500. But the carrying amount is 150. So therefore, there will be profit, right? Good. So it will result in profits. So now that we know that it's a profit, you come and write it here. Profits on disposal. So profits on what? Profit on disposal. And you show the workings into brackets, 500 Ghana less 150 cedis. Good. And what's the answer? Because that's a proceeds less the carrying amount. And that will give us 350. Good. So it means that the profit is what? 350. And that is it. Good. So that's the 350. I hope you get it. Good. Now, why are we reversing it? We are reversing it because profit on disposal is not an operating activity item. It's an what? Financing. Sorry, it's investing. Now the issue is that profits, have they added to this profit or they've subtracted? Now, Madam Lillian, tell me, profit, have they added or they've subtracted? Profit on disposal. Is it in these profits or they have deducted it? So profit on disposal, we said that if it's profit, add it to other income. Whatever they've added, it has what? Entered the profit. So they have added it. Automatically, they've what? Added. So it means that this 350 has been added. Meanwhile, it's supposed not to be there. Profit from or profit on disposal, it is not an operating activity item. So what do? We have to reverse it. How do you do the reversal? You have added. So reverse it by what? Subtracting it. How we get it? Good. So here we are subtracting it. Why? Because they have what? They have added. So we are doing the reversal. Then when we go to investing, we said that it is not operating activity item, is what? Investing. When we go to investing, we are not going to add a profit because profit is not a cash flow. It's not cash. You have to pick the cash element of this transaction. How much it was sold for, that's the 500. So the proceeds will go to investing. So this figure goes to where? Investing activity as what? Inflow. Why? Because that's the money received, though the profit is it. Yeah, the question then, why is it that we did not reverse the 500 here? No, you can't reverse 500 because they have not recorded 500 in here. They have recorded 350 as profit. The question is, how do you know that they've recorded 350? Calculate the profit. Once is the profit, they've recorded it, automatic. So that is it. I hope you get it. Kindly ask if you have any question. So that is the game. So if this is how the game is, then that's fine. If you have any question, Madam Lina, you still have a question, because I can see your hand up. You still have a question, Okay, it's gone.
No, please. No, please.
Okay. Okay, now let's move on. Good. So don't forget when you go to investing. Now we are moving on. Is there any other item again that will affect the adjustment? Adjustment, you say what? Depreciation, profit on disposal. If it has been a loss, as soon as this guy was a loss, not a profit. Loss, they have subtracted from this profit. So what do? Reverse it by what? Adding. Have you seen? How do you know that loss they have been subtracted it? It's from what? P&L, profit and loss calculation. Loss you subtract. Loss will be subtracted from the profits. It will be added to operating expenses and then they will finally subtract it from where? The profit. Now let's move on with the note. Is there any other item? So have you seen the show? Yes. Good. So that is it. Now let's move on to changes in working capital. Now we move on to important show. In fact, that session I like it. Please, that session you do justice and do it for us, okay? Because that session will probably give you 10 ticks. We call it changes in working capital. So we are moving on to changes in working capital. Changes in working capital. Changes in working capital. Now, there are 3 working capital items. Look out for their changes. That's all. You are done. Inventory. Inventory. Good. Inventory. Trade receivable. Then check for trade payable. That's all. The movement. Whether it has increased or not. So I hope you get it. Changes means movement. Has it moved like increase or decrease? And now we said that increase in inventory, increase and decrease, either is what? Inflow or outflow, depending. So take note. Can I take the depreciation off? This session is gone. Now, there was a table that we came across when we were doing it. Please, it's something like this. Good. We said that with, yes, increase. And here's what? Decrease. Yes, inventory. Yes, receivable. And here's payable. So when inventory increases, is it inflow or outflow? That was the question. So that was the table that we normally use as a guide. We said that when inventory increases, it means that you've spent money to go and acquire the goods. So it's what? Outflow. And outflow means negative. We also said that when inventory decreases, it means that you have probably sold some of what? Your goods. And money has what? Money has been received. Or money has come inside. That is it. Another one, positive inflow. It's the same for that of receivable because they are in the same class. Inventory is an asset. Receivable is an asset. So they follow the same pattern. So increase is still outflow. Decrease is still what? Inflow. That's the meaning. Now, when your receivable increases, this is the meaning. At the start of the year, only 200 people were owing you. By the end, 300 people. So that's what? Increase. Why are we saying it's an outflow? Now, the difference of 100, it means that during the year, you have sold additional goods costing 100 Ghana to the people. So the question, where do you get that goods from? You bought it with cash and you are selling to the people without taking money. It's on credit. Receivable, trade receivable, debtors figure has increased. It means that you have given them additional goods on credit. Where do you get those goods from? You use money to acquire the goods, right? You use money to acquire the goods and dispatch it to them. So you have given them cash in the form of goods. We have given them what? Cash in the form of goods because they've not paid us. So that's what I'm saying is what? It's an outflow when your receivable balance increases. You have given them what? Goods. You have given them goods. So you are giving them cash in the form of goods because you have not received the money. You have used your 100 Ghana to go and buy the goods and give it to them on credit. So indirectly, you have given them the 100 Ghana cedis. Oh yes. You have given them what? The 100 Ghana cedis. So that's what I'm saying is what? It's an outflow. Now, when it decreases, that's the good news. At the start of the year, 200 people were owing you. At the end, only 150. It means that 50 has come and what? Redeem their debt or pay off their debt, part of their debt. So it's what? Inflow. So when receivable decreases, what? Inflow. That's the good news. Now let's go to payable. When payable increases, in fact, once you know one, just know one. Know for this. When inventory increases, it's an outflow. The reverse is what? Inflow. Good. It's the same for receivable. Good. Then the reverse, inversely true for what? Payable. Have you seen the rhythm? When inventory increases, it's an outflow. Well, but the opposite is inflow. Good. And it's the same or true for what? Receivable. Why? Because an asset. And then it's what? Inversely true for that of what? Payable. Why? Because a liability. So have you seen the rhythm? I know that the song is not nice. Don't worry. We will make it look good. Now, payable. When payable increases, so opposite of outflow, that's inflow. When it decreases, it's what? Outflow. So that is it. Now, why are we saying it's an outflow? Outflow, you subtract. Inflow, you add. Payable, people that you owe, you purchase on credit. At the start of the year, the payable figure is 1,000 Ghana. At the end, it's 1,200. Wow. It means that during the year, you've purchased additional goods costing 200 Ghana cedis that you have not paid. So the question is, you have taken the goods. You're supposed to give them the cash. But that cash is still with you. That 200 Ghana is still with you because it's not paid. Oh yes, the cash has not moved. It's not paid. So that cash, that money is still with you. Okay, so it means that the suppliers have given you what? 200 Ghana cedis in the form of what? Goods. Your 200 Ghana cedis is supposed to move from you. But this 200 Ghana cedis is still with you, and they have given you the cash. So they have given you the goods. So it means that they have given you cash in the form of goods. So when payable increases, it's what? It's inflow. That's the good news for us. But when it decreases, that's the bad news. They force us to come and pay. Maybe here's 900. Payable has decreased. Currently 1,000. The open balance is 1,000, but the closing balance is 900. They force us to come and pay or redeem 100 of our debt, and that's what? Outflow. So that is it. Okay, so that is it. Good. So I'll be get it. So now check for me. You are going to check for me whether the inventory has increased from this question or decreased. Whether payable has what? Whether receivable has what? Increased or decreased. Or whether payable has also decreased or increased. Check for me first. Now, all what we need is whether it has increased or decreased. Whether it has increased or decreased. So take notes. Good. Now let's continue. So check for me. Now let me upload or show the question. Then you check. So let's go to payable first. So let's go to inventory first. Sorry. Inventory. Okay, so inventory is there. The current assets. Inventory figure is what? At the start of the year. So at the start of the year, the inventory figure is what? Inventory at the start of the year. Inventory figure at the start of the year is what? At the start is 38. At the end is it 34? So check for me. Hello. Yeah. Cool. I'm in class. Let me call you back in. Okay, that's fine. Okay, so you can see that the inventory figure. Chai, I was picking different answers. So where's the inventory figure? Good. So at the start is what? 3,800. At the end is what? 3,400. So it has what? Decrease. Good. Now that you know that it's decrease in inventory, well, this is what you do. Decrease in what? Inventory. So when you go to the face, you write. I mean, I wrote inventory here. So you write decrease. So attach with it. Decrease in inventory. Do your workings. Put the answer here. The answer should be in the first column. So let's do the calculation. So it's a decrease in what? Inventory. And then the answer should be in the second column. No, the first one. The first currency. Obviously, the first currency is here, right? Yes, let me dip it for you to see it well. Good. Good. So it will be somewhere here. Now open your bracket here. Once you say decrease, it doesn't matter which one comes first. It was 3,800 less 3,400. It doesn't matter. Once you know it is decrease, what matters is you are finding the difference. You can also start like this: 3,400 less 3,800. No, the answer will be negative, right? Doesn't matter. What matters is we are saying what? It is decrease. Good. So take note. Just find the difference. The difference is what? 400, right? You place it where? Here. So the first currency, 400. How we get that? Why is my camera sliding down the answer? So 400. Good. How we get it? So 400. Now, as usual, when I do one, you do one. One-to-one mapping. So I've seen the game. One-to-one mapping. So check for receivable. Please, the receivable. We need a trade receivable. We need a trade receivable, not other receivable or the account receivable. So take note. Why am I saying this? Because account receivable is a combination of the trade receivable plus the other receivable, except in the question where they don't give you enough information for you to look for the difference. So that is it. Okay, so now let's go. Let me project it. If your solution is ready, let me have it. Let me have it if your solution is ready. Whether increase or decrease. Receivable. So try for me. Kindly try for me. Kindly try for me. So let's go to receivable. Receivable is what? 2,800 at the start and 3,900 at the end. So has it increased or decreased? So receivable, has it increased or decreased? Oh, no one is minding me. Increase or decrease? Madam Lillian, increase or decrease? Good. I'll start mentioning names. Has it increased or decreased? If I do one, you do one. 1 to 1 mapping. Now I've done mine. Leave it yours. Waiting. Increase. Okay, good. Madam Sicho and Madam Elon. Yes. Everybody should type. So you can also say increase, decrease. So who will support me with the decrease? Huh? Huh? Yes, in fact. Good. I like that. I like the response. So we subtract, that's outflow, right? Okay. I'll start with the decrease or increase. The inventory, when inventory decreases, is it inflow or outflow? Yeah, it's an inflow, so it's positive. Good. Okay, good. I like that, Madam Ellen. That's increase. Good. Okay. Hey, someone is sleeping. Chai, someone is sleeping in the class. Chai, someone is sleeping. Don't sleep. Please don't doze up. Okay, so to confirm this, everybody should type the increase. Let's see. Someone will not type it. Now let's see. Okay, so increase in receivable. So that is it. Increase in receivable. So right here, increase in receivable. Then I'll do the workings into brackets. Increase in receivable. Into brackets. It was 3,800 less 2,900, right? That'll give us 900. And increase in receivable means outflow. So what do? We subtract, as Madam Lillian said. Good one. Good. We subtract. Now let's go to payable. So payable. Hey, so that one is on me, right? Let me throw it back to you. So let's go to payable. It's an current asset. Trade payables. It's 3,200 at the start. At the end, it's what? 3,700. So has it increased or decreased? So trade payable has moved from 3,200 to 3,700. So that's nice. That's interesting. Good. So it has also what? Increase. So you say increase in what? In trade payable. Then you open a bracket. It was 37 less 3,200. And finally, to give us what? 400. Sorry, 500. Now, this 500 that we have here, this 500 is what? It is inflow or outflow. Tell me, is it inflow or outflow? When payable increases. When payable increases, it's an inflow. So plus, right? Positive. So tell me the net answer. What's the net position? Tell me the net position. Tell me the net position. Good. Tell me the net position, adding all the three together. The net position. Tell me the net position. Tell me the net position. 1,800. I disagree. 1,800. We are adding. Okay. Now let's see. The net position, adding 1, 2, 3 together because they were on the first currency. This what you get. Let's put the 3 together. Good. What do you get? 0. I like that. Please, have you seen me writing it? 0. They throw dash. Throw the dash like this. You two throw dash there for you. So 0. Please sum these 3 up. 1, 2, 3, 1, 2, 3, 4. Good. That answer we call it cash flow from where? Cash flow from operating activities before what? Cash generated from operations before interest and tax. But it's long, so we can probably call it operating cash flow before interest and tax. That's what I call it. So put 1, this answer plus this, and then we answer. So what do you get? Good, what do you get? So that's operating cash flow before interest and tax. Operating cash flow before interest and tax. No shortcut on exams. 3750. I like that. 3750. Okay, I'll take that. 3750. Now let's move on. If this cash flow is before interest and tax, so what's the next item? Interest paid. So interest what? Paid. Interest paid. And then tax what? Paid. That's the last line item. Here we don't need to get subtract the interest paid first and get cash flow before tax. No. Just bring the two here like that, like this, and then you are done. That's all. Okay, let's go and do the workings for all of them. Don't forget the workings that we did in the first lecture. The workings that we did, and then the shortcut that we gave, or we probably came across. Okay, so that is it. Now, is the open balance. Add that item to it. Let's the closing balance. You are done. Anytime you are looking for something paid, not adjustment to, please. Something paid. What do? Open balance, that item will be from P&L. Open balance, that item in the P&L. Let's the closing balance. You are done. You get the paid. Sorted. So if you want to get the tax and then the interest paid, what do? So workings number 2. Interest paid. Now check the current liability if you see interest payable there. Good, the interest paid. Now what do? You check the current liability. Check and see if they are owing interest, because we have interest expense, which is the same as what? Interest incurred. But it's not equal to what? Interest what? Paid. Oh wow. Sometimes it's not equal to. We have only one critical situation where the interest expense is equal to paid. Yes. Now the interest incurred is what's supposed to pay. Yes, what's supposed to pay. Good. And then the paid one is the actual part of it that you paid. So assume that you're supposed to pay interest of, let's say, 1,000 Ghana. Now, So the interest expense is equal to what you paid. You paid 800 plus what you owe, 200. So what you owe plus what you thought paid, that gives you what you're supposed to pay. Good. So take note. You are looking for what you've paid. Okay, so now let's go to the question. Now, how do you know that we have to use this approach or we have to massage it? It's only when there's what balances on the financial statement. Wow. Sorry. Now let's go to the question. Now when you go to the question, current liability, we only see income tax and trade payable. So meaning they are not owing any expense. They are not owing any of the interest. So when happened that way, the interest expense is the same as what? Interest paid. Good. So that's the critical situation. Where you are not owing, assume that here you paid the entire 1,000. It means that here the owing is what? 0. So the truth of the matter is that where you are not owing interest, the interest expense is the same as the interest paid. Good. Now when you go to the initial section of the cash flow, now go there for me, cameraman. Good. When you go to the initial section of the cash flow, there's add back interest expense 300. Now we've checked the financial statement. Now we have checked the financial statements. The financial position, there's no interest what? Expense. So there's no interest owing. And if there's no interest owing in the financial statement, then the interest expense is the same as the interest paid. So good news. So here we are free to copy the interest. Good. So the interest expense 300 over here. They have paid all. They are not owing. So when we go down, and we go to interest paid, here too, we will pick what? 300. Why? And subtract it. Why are we less than 300? Because the interest expense is the same as the interest paid, because they have no what? They've paid all. No owings is on the financial position. That's good news. Now let's move on. Tax paid. Tax what? Paid. Now let's go and calculate the tax paid. So it means that our workings that we wanted to do for that of expenses, like the interest expense, we rather do it for tax paid. So workings 2 rather will be for what? Tax paid. So I just have to change the item. So interest, no workings for interest. So tax paid. That one to start. The open balance. Check the current liability first and be sure that they are owing. Because if they are owing, it will be among the current liability on the financial position. Now when you go to the financial position, the current liability, you see income tax there, right? You see income tax there. Good. Income tax of what? 700. And then that of the closing balance. Open balance is what? 600. So that's what you're going to do. So let's come here. Say open balance. Right? Open balance. Or balance brought forward. Yes. Open balance is 600. Good. Then the P&L. What's the income tax expense? The P&L. Right? P&L here. That's the income tax expense. The income tax expense or income tax incurred. So income tax expense. Where will you see the income tax expense? It's in the P&L. So you can easily write P&L here. All of them, they are the same. Good. There's a question for me. Let me go and pick it up. Okay, so kindly ask the question.
Right. So Fred, I think I'm not getting it so well when it comes to the interest paid.
Yes, with the interest paid, we are saying that they are not owing. They are not owing. If they are not owing, whatever they've expensed, it means they paid it. So we said that if you want to get the interest paid, interest expense is equal to whatever you paid plus whatever you owe. Now adding these two together. Now we know interest expense to be 300 and they are not owing. Owing is 0. So what to be the paid? Paid is to be what? 300. That's it. So now the issue is that anytime you check the financial position and then the interest, there's no interest owing there, or there's no interest among the current liability, it means that they are not owing interest. And if they are not owing, establish the fact that they are not owing interest first. Check for the financial position. Check the current liability section. Do you see any interest among the current liability? If there's no interest, they are not owing. And once they are not owing, the interest expense is equal to interest paid, meaning they've paid everything. All the interest expense, they paid all, they are not owing. So that's the same answer you're going to probably take and then bring it here. I hope you get it now.
Yes, I do. But the 300, where do we pick that 300 from? Is it the one at the loan note interest?
No, go to the P&L. That 300 is the 300 that we pick from here. Good. Is this 300 that we are bringing it here again? Is it 300?
The profit before interest and tax.
No. It is the 300 that we added to the profit before interest. So that this 300, that's the interest expense, the finance cost.
Okay.
From the profit and loss. So they are comprehensive income. What's the finance cost?
It's 300.
Good. So that's it.
Okay.
Now let's. Good. Can if you have any question, can you ask so? Yes. Okay. Now let's move on. So the open balance of the tax paid, so of the income tax is 600. Let's go and pick the income tax expense from the question. The income tax expense from the question is what? Income tax expense. Here's it. Income tax expense from the P&L. So you pick it. The figure is what? 700. Good. That's 700. That's 700. Meanwhile, the closing balance due is what? 700. Okay. So that confirms what they said in the notes. Hey, why? Good. So now let's go and then put it up. Then you are fine. So here's 700. Then closing balance. It's also 700. You less it. That's all. Just less the closing balance. Then this is the tax paid. Tax what? Paid. So anywhere you're looking for tax paid, the format is straightforward. So this is the format. I want you to get the format clear. What do? Pick the open balance, add the income tax expense. Where can you see this in the P&L? That income tax expense that we calculated in the P&L, that's the CUD. But here they don't want the CUD. No. Here they don't want the computation. No, it will be calculated for you in the P&L already. So no, now they assume that you know how to prepare P&L, the profit and loss, and the financial position well. So that's why they will give you all the details information. Good. So that is it. Okay, so putting all together, what do you get? You get what? 600. So it means that during the year, they paid all the open balance. That was the note that they stated. There was one of the notes that says that they paid all the income tax brought forward. That's the meaning of that statement. Now, when you go down, one of the notes, note 3, it says that the 2004 income tax liability, that's the open balance, which is 600. Where's the 600? was income tax liability. Was the liability was the one that settled in 2000 and what? 2004. No, let me take it again. The income tax, the 2004 income tax liability was the liability. Was the one that settled. Okay. In fact, that liability is supposed to not be there. This figure is repetition. The 2004 income tax liability was settled. This was liability, should not be there. Was liability, should not be there. So now the full version will be the 2004 income tax liability was settled at the amount provided for in the books. So it means that 600 has been settled. So that is it. In fact, whether that note is there or not, it won't change the situation. It won't change the solution. Whether that note is there or not, it won't change the situation. So that note is not very important. Now let's go and key it in. Now that we know that it's 600, let's go and then put it in our books. So tax paid will be what? Tax paid will be 600. Please get me the net cash flow from where? Net cash flow from OA, operating activity. No shortcuts in exams. Net cash flow from operating activities. Now let's get it. So put them together, what do you get? So after taking the 600 from this minus this, so you get net cash flow. Net cash flow from where? OA. Please, if the answer is positive, you can. Please, what do you get? 3750. No. Kindly do the calculation for me. Please get the answer for me. So 3,750 less 900. So that will give us 3,100. This was the answer. If you get, you can tap it for me. Good. So 2850. 2850. Make sure that I get the same answer. Yes. 2850. Now I wanted to explain this. If the answer is positive, you are sure, 100% sure, everything sure, you are sure that is positive. Tell the examiner that is net cash inflow. Net cash what? Inflow. But if you don't want trouble like myself, write net cash flow. But sometimes your additions supposed to be negative, you didn't make it negative, and then you are saying it's inflow. So that is it. So take note for me. Now, someone is having a question. Let me go and pick the question. Let me go and pick the question. So you can ask the question now.
All right. So Fred, please, for the tax paid, please can you go up a little so that I show you what I'm talking about?
The tax paid.
Yeah, please go up. I can't see the working on the tax paid app. So please, for the tax paid, I can see that the opening balance was 600.
Yes, opening balance 600. Where do you get it from? It's in the previous year's financial statement. Check
Yes.
the current liability. Good. Then you add income tax expense to it.
Okay.
Then you less the closing balance. This is the closing balance from the current year financial statement. You check the trial balance and see if it is there.
Okay. Okay.
You get it?
I get it. Yes, please.
Okay, so now let's move on. Good. Okay. Now we are moving on. So on that note, we have successfully finished the cash flow from where? Operating activity. Now I'm giving you just 5 minutes for you to scan through and copy it. If you don't understand anything, please let me know before we move on. Other than that, it's like we are moving the confusion forward, and then it will be getting worse as we move ahead. So please get it. If you don't understand, let me know. I'm ready to explain each and every part again, over and over again, until what you get it. Yeah, so please get it for me. So let me know when you are done. Good. Good, welcome back. Now let's go to the question, the original question. Kindly check the question for me. What was the carrying amount of the disposed asset? Is it 150? Is it 150 or 350? The carrying amount of the disposed asset. Is it 150 or 350? Check for me. So now the question, the carrying amount is what? Hey, 350. So please, you have to make entries. You have to make some changes. So wherever you use the 150. So who gave the 150? Myself, eh? It was imaginated figure. Yes, it was myself. I gave the 150. So it's supposed to be 350. That's the carrying amount from the question. Good. So let's make that changes. So where will it affect? Try to affect the depreciation. Have you seen? First, let's go to the depreciation. For the depreciation, so let's say we can probably change it from here first. So here will be 350, right? So the profit will be 150, not 350. So take note for me. That's it. And then we will go to wherever we depend on that 150, or wherever we have placed it, we have to go and then change it there. And then the workings one to the accumulated depreciation that we use to not be like that. Now let me come to the board. Good. So we're saying that the current amount from the question originally is 350, not the 150. Yes, the 150 was marginated figure. So take notes. So taking that 350 from the 500, it gives us what 150. So it means that this answer will change. So take note for me. Good. So we change it. Then now let's go to this answer to, I suspect it, because the accumulated depreciation. Because the accumulated depreciation that we used, it will probably affect it. That's the only section. But who gave me that 150 Ghana cedis? I imaginated it. Okay, I wrote some figure B on the board. I don't want to go back, be taking you off. So, hey, the cost is what? Cost is 800. And then the carrying amount is what? 350. So what will be the accumulated depreciation? So accumulated depreciation will be what? Will be, please, what do you get? Accumulated depreciation. It will be 450, right? Okay. So have you seen the calculation for the depreciation? We wrote accumulated depreciation 650. No, it's supposed to be what? 450. So make that changes for me. So to affect this guy. So taking 450 from there, so 450 from here, so like to be 1,000. Be like 1,000 cities or 1,800. Okay, someone had 1,800 there. Oh. Okay, so do those changes for me and then let me know the answers. Finish. I hope you are not that confused. You can do it here. The depreciation, the calculation of the depreciation. We show open balance. Do I remember the figures? It was 4,800. We said disposed are supposed to be what? Into bracket the 800 less 350. That'll give us 450. We subtract. I hope you get that. Good. So this figure, we made it 150. So it was 650. So that was the issue. So the charge for is the balancing figure. So to affect for the charge for the year, that's the depreciation charge for the year. Meanwhile, the closing balance will still be intact, right? That's 5,600. Of all of you are there. Good. I like that. So 1,250. Okay, that's good. So putting all this, now the new balance 1,250. 1,250. No longer the 14. Good. So that is it. So confirm that for me and then you'll be fine. Okay. Okay, so what do? We come here and then here will be 1,250. And then that's all. So let's do the calculation again. So get the figures again and then kindly go to the changes and then you'll be fine. Good. That is it. So let's finish hard. I'll try as much as possible to finish this question before 2:40. So get those figures for me and then let me finish it quick. That'll be the class was successful. And so what's the changes now? Now get me this figure first. This, and then this one. 2,650 plus 1,250 less 150. That is it. Less 150. Good. So what do you get, Madam Lillian? You had 1,250. 3,750. Wow. What's the same answer? The same answer. Interesting. 3,750. It's inside. When I'm going to bring it. So this. 3,750. Wow. 3,750. Will it affect this? And I take it from this, and then you get that. The 3,750. Wow. So it's still giving us the same answer. Meanwhile, it was wrong. It's still the same answer. Two change. Because you use 200 here, 200 here. Wow. That is it. Yes. Of compensatory. Wow. Remember all this. F compensation. Wow. It means that you have the basics. So still the net answer is correct, right? Now we are done. So now we are moving on. This is what? Cash flow from where? Operating activity. We are moving on to what? Cash flow from where? Investing. So look at how you're going to do the investing and then you are done. Investing. Cash flow from investing. So if you have any question, kindly ask before I move on to cash flow from where? Investing activity. Good. So don't forget the entries. Now let's move on to cash flow from investment activity. Can I clean this section and do it here? Yes, I'm going to clean that section and do it there. Hey, still not clear. Don't worry. I've still not clear. Okay, to be fine. I think this one is okay. Going down slowly. Going down slowly. So have you seen it? With the tax paid. Okay, the tax paid is 600. That one is down. It's down. 600. The tax paid is 600. So good. Now let me clean it and then let's probably proceed. We have only 25 minutes. 25 minutes more. The next 15 minutes, we're going to use it. Don't forget the history of the day. Watch the last end to get the history of the day. So every day there should be history. So let's go to cash flow from where? Investment activity. You have to continue. My book is what? Exhausted. That's why I'm cleaning it. Take note. So give me this figure. I'll request for it. So you give it to me. I'll request for it and then you give it to me. Good. Okay, so cash flow from where? Cash flow from investing activity, IA. IA, yes. No shortcut, please. No shortcut in exams. No shortcuts. I don't have space here. That's why. Cash flow from investing activity. We are saying that with the investing activity, just look for only what? One item. Go to the non-current assets. Non-current assets. The changes, that's all. And other income that they had. And then investment income. Proceed from sale of what? PP. If they sell any of their PPE, bring it there, and then you are done. So let's go to the financial position and see whether they acquired assets. So don't forget that they sold the asset during the year. They sold what? Asset during the year. So ideally, if they've disposed part of the asset during the year, then all other things being equal, the asset value should go down, right? It shouldn't go up. So let's go and check. Now let's go to the question, the financial position. Now the assets. The open balance of the non-current asset is what? It is 8,000. The closing balance, let's take the carrying amount. The open balance of the carrying amount of the asset is 3,200. Whereas the closing balance is what? Whereas the closing balance is 5,400. Why? You've disposed of some of your assets, still it's going up, meaning there was acquisition. So let's go and calculate it. Please, yeah, most of the question we won't tell you. That's the truth of the matter. Most of the exam question, we will not tell you that during the year they acquired PPE. No, not at all. If open balance is 3,200 and they sold some during the year, they sold assets, and still the balance has increased to what? 5,400. Then there's what? Magic. How on earth can you sell part of your asset and still it's coming up? So what do it means that during the year they purchase some, right? Good. So you have to now find balance and striking of averages to now know the balance or the asset that were purchased. So we have a nice workings that we are going to do. Yes. On a face like that, there are a lot of items that we have to probably affect. So you are going to do those workings. Good. That is it. Okay. So now let's do that working here. Let's do that working here. So workings number what? I think 3. Right? Good. So workings 3. Because it's purchases of PP, just call it PP or non-current assets. Open balance. Bring the open balance. The open balance from the question is what? 3,200. How do we get that? Let me know if you can't see. Wow. But it's not visible. Sorry. Good. Okay, I'll be talking now. I don't know why the picture quality is very bad today. I don't really know why today. Our camera is okay. I think it's okay now. Good. Yeah, this one is fine. Oh, when I come here like this. When I come here like this, it's fine. Okay, let's move on. Don't forget your 3 zeros. 3,200. Now let's move on. They dispose assets. Please. Yeah, I have about 3 approaches where you can do this. The same question, 3 approaches. But please go by this. You bracket the current amount session or the current amount style. Hey. Good. Now, what is the current amount of the disposed asset? Disposal. The cost was 800. The current amount was 350, right? Good. So 350, you less. Because ideally you should reduce your assets. Thank you. Now let's move on. Is there any other item? Is there a revaluation in the question? Yes, there was a revaluation. There was a note that states that the movement in the capital surplus represents a revaluation of what? Non-depreciable land. Which note is that? It says something like that over there. It says note 2. The capital surplus increase is as a result of what? Revaluation of some land that was not been depreciated. So that is it. So let's go and pick the movement in the capital surplus. Movement in the capital surplus. Open balance is 1,000. Closing balance is what? 500. So that's revaluation gain. But our don't say it's revaluation or gain. So that's 1,005 less 1,000. Let me do it down. Good. Let me do it down. Let me step him down. So into bracket 1,005 less 1,000. And that gives us what? 500. That's revaluation gain. We said that when there's a gain, add it to the assets. Add the gain to the current amount of the asset. You have added the gain. Have you seen the accounting treatment that we did under the P&L section? The same thing that we are doing here. Good news, we are fine. Now what do you do again? Don't worry, you close soon, don't worry. It's almost done. Let me just do attempt that we are done. But the troublesome guy, we are done with it. That's the cash flow from operating activity. That one is very long. Cash flow from operating activity is very long. But the investing and financing there, they're just like so straightforward and easy. So don't worry, you'll be fine. Is there any other item that will affect this? What's the depreciation charge for the year? Depreciation. The depreciation charge for the year, we had 1,250. Good. Depreciation charge for the year, 1,250. What again? So we have to bring all these items here, 1,250. That's the depreciation charge for the year. Good. Then what again do you bring in here? Good. Okay, that's all. Then if this is not equal to the closing balance, then the balancing figure represents what? Purchases. You write cash here. It represents PPE that they acquired during the year by cash. That's X. So if this is not equal to the closing balance, how do you get the closing balance? Closing what? Balance. Now the closing balance is in the financial position. That's 5,600. That's the closing balance, 5,600. So the question is this: what should you do to this so that we can get this? That's it. Don't forget to subtract depreciation. Depreciation should be subtracted. How we get it? Good. So that's the good news. And then we are done. So do the calculation for me. Lillian. Yes. If the answer is ready, then I'll pick them. So 3,200 minus this, plus this, minus this. Answer. Then you compare to this before you make the movement. So 350, 3,200. This one, no idea. That's 150. That's 150. 250 plus 150. That's 1,400. Good. 1,400. Taking from 3,000, 7,600 plus 1,008. Take it. 1,008 from 5,600. Wait, the difficult plenty. Yes, please, what do you get? Everybody do the calculation and get me the answer. Wow. Wow. This is it. This is the mission of marginal return assertive. Good. So what do you get? 3,500. Okay. This sum all this one up and let's see the answer. 3,200 plus less 350. Less 350. Yes, plus 350.
2,008.
Plus 500. Less 1,250.
2,100.
Good. The difference between this. So less 5,600. So that's 3,500. Good. You said that thing. Okay, so that's fine. 3,500. Good one. So that's the purchases. Please, let's write it here. Don't do the entry first. I don't know. Somewhere. Depreciation. So this is the cash purchases, 3,500. So cash. So that's the cash purchases of PPE, 3,500. The balancing figure, bracket balancing figure. So that's it. So you come here, and then you come to the assets, and then you are done. So you say acquisition of what? PPA or non-current asset. Kindly put it here, place it where? Here. That's 3,500. Third examiner, workings number what? Number 3. Please put it in a bracket. Why? Because it's an inflow. When you buy non-current asset, money will move out. money will not come in. It will what? Move on. Thank you. Now let's move on. Is there any sale of PPE? Yes, they sold PPE for how much? 500 Ghana. That amount is an investing activity. It's an investing item or investing activity, that transaction. Good. Though the cost of the asset disposed is what? The cost of the asset disposed is 800. The current amount is 350. They sold it for 500. But here we want the proceed, the amount. Even though we have reversed the profit element of 150 in from the operating activity, because that's what they will add. You don't need to go and then reverse the 500 because they will not add the 500 to their profit. They will add 150. But here, when you come, you have to record what the cash element. So this, out of these three figures, which of them is the cash? This is the cost, current amount, proceeds. The proceeds is the cash. So you have to record it. So you call it proceeds from what? Sale of PPE. So that's what? 500. What again? Investment activity. You have investment income, other income, interest received, all of this, if you have them in the question. There's no, now, you don't have anything like that, right? Like dividend received. So if there's no item like that, you move on. So you are done with investing. So though of investment activity, only two items. Some question, just one. But the stubborn guy is operating activity. That one have a lot of items. So take notes. Investing is just two. Putting this together, I get what? 3,000, right? Good. So this is 3,000. And this is what? In fact, step the 3,000 down so that we can call it a name, a very nice one. Step the 3,000 down so that we can call it what? Let's step the 3,000 down because it is called net cash flow from where? Net cash flow from investing. From investing activity. From investing activity. So take notes. Now let's go to financing, then we are done. Cash flow from where? Financing. So cash flow from financing activity. FA. Financial account or financial accountant. Yeah, finance, just check the movement in shares, whether they've paid dividend, whether they've gone for loan, issue of loan, check the movement. So basically, go and check the equity and liability. Check equity and then non-current liability, the movement, you are done. So let's go to the equity and non-current liability. Any movement, you pick it. So the movement, they are. So let's go to equity. Equity, 1,000, no move. So there's no movement in equity. So we are not going to touch it. Good. Then capital surplus, you've used it 1,005. That's the 500 if you use it there. Then income surplus. For income surplus, you don't need to worry. Once there's dividend in the question, you don't need to worry. But if there's no dividend, we will confirm it. Good. I'll do the confirmation tomorrow. Good. Now let's go to non-current liability. 10% loan notes from 2,000 to 3,000. So it has increased. So issue of what? Loan notes. So that's the financing activity. Issue of what? Loan note. Let's go to the board. Sorry. What's the board? Good. So the board is here. So issue of what? Loan note during the year. And then you find a difference. At the start, it was 2,000, but then it's 3,000 less what you have at the start. So during the year, we issue what? 1,000 Ghana. Then is there any other item? This 3,000. This 3,000 is in the question. The loan note. At the start of the year, it was 2,000. But at the end of the year, it is what? 3,000. So it has increased by what? 1,000. Good. This 3,000 is coming from here. This summation. Then you pick it there. Good. Now there's dividend paid, right? Dividend paid. In the question, 750. Where is it? It's in the question. The last footnote or so. The last footnote. So let's check the last footnote. The last footnote. Let's go there. Wow. The last footnote. Dividend paid during the year amounted to 750, right? Good. So 750,000. That's the dividend paid. So dividend paid is 750. Let me do it well. 750 So that's the net cash flow from financing. Putting together, you get what? 250, right? But I told you that for financing and investing, don't need to worry. What you have to worry is what? The operating activity, the stubborn guy. Good. So this is the net cash flow from where? Financing. Financing just talks about the debts and then your debt and your equity. So net cash flow from where? Financing. Net cash flow from where? Financing. Here it should be negative because this figure should be negative. But 3,500 is more than the 500 positive. Good. So net cash flow from where? Net cash flow from OA. Good. It's 250, right? Positive because the inflow is 1,000. Yeah. This one. FA, sorry. It's financing. Net cash flow from financing, not. Now let me clean something here. Assuming this is a question, there was a net cash flow. It was continuation. This one was continuation of the previous page. So let me summarize what is in previous page. It was net cash flow from where? From OA. What was the figure? 2850, right? It was 2850. Good. Now, when you are done like this, now you are going to do the magic session. This is the magic session. This one, yes, the examiner himself have to probably salute you because you will get the answer right. Even if there's something wrong there, you get that answer right, the final answer. You have to add this, plus this, plus this. That's the net cash flow for the year. So net cash flow for the year. Don't even worry yourself to do that. Net cash flow for the year. Don't worry yourself to do that. Adding from the net final answer from operating activity, from investing and from financing together. Why am I saying this? I'm saying this because what if there was a mistake here? If there's a mistake here, it will probably translate and then this answer will be wrong, right? My friend is saying this answer, you have to get it right. Now, when you add this answer to the open cash balance, it will give you the closing cash balance, automatic. Meaning it has balance for you. So where there's a good news, so what do? Say cash and cash equivalent at the start of the year, at the start, open balance. So open, you can write open balance here or at the start of the year, so much. When you put this figure together, it will give you the cash and cash equivalent at the end. So cash and cash equivalent at what? At the end. That's the closing balance. Hey, sorry, in fact, you can't see all this. Let me go over again. Sorry. Now, after adding the final answer from the 3 points or from the 3 perspectives, from operating, investing, and then finally financing, you get an answer called net cash flow for the year. For that one, you don't need to add these ones. You do some change of subject. Now, when you get that answer and you add the open cash and cash equivalent, now the question, what is cash and cash equivalent? I will explain it to you. Some of the terms, cash and cash equivalent. Yeah, cash. Okay, so money that you have there, whether in the bank or it's in what? Your cash still, good. And cash equivalent. Sometimes you have some instruments, some investments, then they are not cash, but they are readily, you can easily convert it into cash. They are called cash equivalents. Not over 1 year, within a year. They are short-term, highly liquid investments, which can be converted into cash within 1 financial year or without any significant change in value. The value will not change. I think tomorrow I'll take my time and explain those terms to you. Today we are just learning the computation. So the cash and cash equivalent at the start of the year, you add it to the net cash flow for the year. The answer that it will give you, it is the closing balance. It is the closing. And these 2 answers, we know it. We can get it from the financial statement. That's the cash balance. That's the closing cash balance. This is the open cash balance. So let's go to the question and go and pick these figures free. Then when you massage it, to give us this answer. So when you go to the question, open cash balance is what? What's the open cash balance? 4,800. Open cash balance. From the question. Good. So cash at bank and cash in hand. 400 is the open balance, and then the closing balance is 100. No, I've changed them. Open balance is 100. So the open balance here is 100. And the closing balance is what? Closing balance is 200 or 400. Closing balance is 400. Good. This balance is 400. That's it. So have you seen? Now, please take note where I pick the figures. Tomorrow's question, I'll do more about this because sometimes I have to do some workings on this cash and cash equivalent. So tomorrow's on. So the closing balance is 400. Have you seen where I pick it from? Current year financial statements. Open balance is what? It's 100. Open balance is 100. Good. Now when you get this, you are fine. It has balance for you. Whether it's balanced or not, you have balanced it. Now, what should I do? There's a figure here. When I add to this, I'll get 400. What's that figure? Tell me. It's 300. I'll be with me. It's what? 300. So when you put this 300 here, when you put the 300 here, when you add, get the 400. That's all. Don't even worry yourself to add this. Don't even worry yourself to add this and this and that, because if you add and you don't get 300, it's wrong. So add it and see. Yes, we subtract. So 2850 plus the 3,000 less the 250. What do you get? Is that?
Are we subtracting the negative?
Yes, we are subtracting negative. Wow. Good. So that is it. So the closing balance is 5,400, not the 5,600. So basically, it will probably reduce this guy to 600. It reduced by 200, so that's 3,200. So you get it's reduced by 3,200. So 3,200 is then. Yes, that's what I was expecting. 1,000. So 3,200 less 350. Good, less 350. Hey, why? But I with that video. That's what happened to you. Huh? Try. Freezing calculator. Hey, Sunday. Too serious. Yes, so plus 500. Please check the figures. Should be checking the figures well for us. Then let's. I have only 2 minutes. 2 minutes more to go. Plus, that's all. Good. So let's 5,400. That's 3,300. Good. Please get it for me. This figure will change by 3,300 to reduce. I'll be get that. So it should be 3,300. Why? Because this one's supposed to be. Don't know where we picked that figure from. So it's 3,300. So when you come here to be what? 3,300. Finally, when you put these two together, what's the answer? So 3,300 answer plus 500. Yeah, that's 2,800. So here's 2,800. Then we are done. 2,800 negative. Good. Finally, you get the answer. You are done. So check the figures. So when you put it together, you get a 300, right? Yes. So have you seen, to illustrate to you that this 300 is the best. How to get this 300 is what? The very best one. So when you put them together, 2,850 less 2,800 plus 250 to give us 300, positive 300, and that's it. Good. So that's the end of the show. Now let's analyze the cash flow. A good company, you should have a positive cash flow from operating. Oh yes, operating activity should have a positive cash flow, meaning you are doing good. So this company is doing good. A good company, because of investment opportunities, your cash flow from investing should be what? Negative. Yes. If your cash flow from investing is positive, it suggests that you are selling your investment. Why? Meaning you are not going, you don't have capacity to what? Expand in future. So you should have a negative. But the finance, it depends. Sometimes you are going for more loans or you are paying your debts. So that one depends. So that is it. Good. And thank you very much for coming. Please go through it and then you'll be fine. Like I said, when you come here, just use this technique to get 1, 2, 3 correct. Have you seen the first time? Instead of you picking 5,600, we pick 5,000. Instead of you picking 5,400, we pick 5,600. So there was a 200 difference, which affected this guy. And finally, when we add, we're not getting a 300. Still, we maintain a 300 because that is the best way. So whichever, in fact, if there's a mistake here to not affect you, this one is what we call comprehensive insurance. That's cover you whether there's a mistake here or not. It won't affect this answer. So this one, you have to get it correct. These 3. That's the first thing normally you do. So take note. Okay, thank you very much for coming. So kindly go through it and then you'll be fine. Tomorrow, we are solving the past question. So that is it, the one that I showed you. Okay. If you have any question, kindly ask before we end the show. Today's history for the day is that who won the First World War? We all of us are lady. The First World War, who won and then who lost the battle? Well, German lost to US and then Britain. And then there's a third country, the First World War. Yes. German lost the battle. Against what? The Great Britain and US. So despite the big and then like experience soldiers that German was having, still they defeated the game. Okay, so thank you. And don't forget to watch the subsequent ones and the previous ones as well. Have a nice day. And please observe all the social distance protocols. Everything I was observing mine. Yes, I was observing mine. Between the board and then to the laptop. Yes. Good. So observe yours too as well. And if possible, please stay at home. If possible. Yes. So goodbye. I'll see you when I see you.